Welcome, everyone. I'm Mary Brown Sands, Chief Marketing and Communications Officer at the Small Business Investor Alliance. The SBIA is the advocacy association for investment professionals focused on America's lower middle market companies. Our association has maintained a key role in promoting the growth and vitality of this industry and the small businesses it supports for more than 60 years. We're pleased to bring you our Lunch and Learn webinar series with today's topic, the impact of COVID-19 on portfolio company valuations. Our series of educational webinars is designed to provide valuable content for our members, industry colleagues, and when the topic is relevant, the management teams of investor-backed portfolio companies. If you have questions for our speakers during the webinar, please use the Technical and Questions feature in your GoToWebinar menu bar. We will monitor this section and the panelists will address questions at the end of the discussion. Also, please use this feature to let us know if you're having technical issues. Today's technical director is Ainsley Hoffman, who will reply with suggestions. Please be advised that this session is off the record. Comments, statements, and materials are for the express use of SBIA members and are not to be published or recorded without approval by SBIA and the professionals at CohnReznick. Today's session is possible because of the support of our longtime sponsor, CohnReznick. CohnReznick is one of the top accounting, tax, and advisory firms in the United States, combining the deep resources of a national firm with the hands-on agile approach that today's dynamic business environment demands. Their SBIC team is comprised of people dedicated to serving the SBIC community and has extensive experience working with established and newly formed funds, including levered and unlevered SBICs, traditional SBICs, bank-operated SBICs, impact SBICs, and business development company SBICs, all with different tax, accounting, and regulatory needs. CohnReznick was founded in 1919 and is headquartered in New York City. Today, we welcome Chris Arrow and Carmen Sims with CohnReznick and Zach Luce with Ironwood Capital. Chris, it's my pleasure to welcome you and your colleagues, and I'll turn the virtual podium over to you to introduce your fellow speakers and start our session.
Great, thank you. Good afternoon, and thank you for joining us today. I hope everyone and those close to you are all safe and well. My name is Chris Arrow, and I co-lead the financial sponsors group for CohnReznick. And joining me today is my colleague Carmen Sims of our Valuation group and Zach Luce, CFO of Ironwood Capital. We're just going to have a conversation on the valuation framework and talk about things that folks should contemplate as they're going through the year-end valuations. And before we get started, I'd just like to do a quick shout out to Brett Palmer and the SBIA team and all that they do for the membership. And they've been really instrumental in the last 6-7 months, keeping all of us apprised as to changing in regulations and the whole environment that they're in. And I know they've been working tirelessly, and we really appreciate everything they do for us. So to start, what I'd like to do is I'd like to ask Carmen and Zach to give a brief introduction of their backgrounds for the audience.
Sure, thanks, Chris. My name is Carmen Sims. I'm a director at CohnReznick in the Transaction and Turnaround Advisory Services practice. A bit of background, I started my professional career assisting closely held business owners with estate and succession planning. Over the past 15 years or so, I've worked with both public and private companies on financial reporting requirements specific to fair value. This includes working with a number of private equity and venture capital fund managers on analyzing and reporting the fair value of their investments held within the various portfolio companies. I've worked with Chris for the past 5 years in reviewing a lot of different analyses prepared for such investments. And so thank you, Chris, for that, and thanks to the SBIA as well. Zach?
Great. Yeah, hi, I'm Zach Luce, CFO of Ironwood. Spent about 7 years, my first 7 years in public accounting before joining Ironwood in 2010. I've been with Ironwood for the last 10 years in the CFO function here, overseeing our investment operations team, really focused on fund reporting, limited partner reporting, portfolio management, as well as on the capital raise side. So Ironwood Capital, we are a firm that really leads with subordinated debt. We invest approximately 25% of our capital in minority equity. We're investing out of our fourth fund. It's a 2017 vintage. It has $424 million in limited partner commitments. Every one of our four funds has had an SBIC component to it. We invest in businesses that are between 20 and 200 million in revenue and $3 and $20 million in EBITDA. And we invest in what we call backbone industries: manufacturing, aerospace and defense, business services, environmental services, transportation and logistics, to name a number of those investments. And I'd like to echo Chris's sentiments for Brett Palmer and the SBIA. Certainly appreciate everything that Brett and the team have done for us.
Great, thank you guys. So we'll get started, and I'd like to frame our conversation along some broad themes. And I think it's always important to reflect upon lessons learned. So we're going to start there, and I'd like to start with Zach. Zach, if you think back, mid-March, the world turned upside down for everyone. Can you just walk us through how Ironwood triaged and assessed the impact of COVID on the portfolio? And then also maybe talk a little bit about some of the considerations that you folks thought about, because you had, if you think about it, when COVID hit, shortly thereafter, you had your 331 valuation marks that had to be done. And so much was just uncertain, not known at the time of those marks. Can you maybe just talk a little bit about, the things that you and the team considered as you went through the Q1 valuations?
Yeah, sure. So I think I'll take a step back in February, when it became clear that COVID was going to have a significant impact here on the economy and on kind of just the broad portfolios here. We sent our first email to our investors, just letting them know that we were aware and really starting to address COVID from a risk perspective within all of our portfolio companies. In March, we then spent a lot of time working with portfolio company management teams. We developed a risk-based matrix to really assess each portfolio company's exposure to the pandemic at that time. So we were looking at key risk metrics such as liquidity was one of the very hot issues, and ensuring that each company had access to liquidity, talking to senior lenders at each of the portfolio companies to understand what their approach was going to be, talking to sponsors in the deal if there was a sponsor. We looked at leverage. We looked at the supply chain, AR, AP, the fixed cost structure. So that was really kind of at the heart of this matrix were those metrics. We were in regular contact with the management teams, providing them with support and guidance on all the different options, including some of the government options such as disaster loans, PPP loans, and also addressing concerns such as workplace safety. And at that time, we sent a pretty robust email out to the LPs to continue to provide them with updates on the portfolio throughout March and into April. So that was more of a weekly, bi-weekly update for our LPs, just to make sure that they understood kind of exposure to the portfolio, et cetera. So I think all of that, what we were doing there was really helping us understand what the key risks were and the exposure at each of these portfolio companies, which was very helpful from a valuation perspective. Albeit, I mean, it was very early, right, in the cycle. There was a lot of uncertainty at that time. Still is uncertainty, but a lot of uncertainty at that time as to what the impact of COVID was going to be. So when we were moving into our Q1 valuations, I'll give a little overview of our general valuation approach here. We take a market approach, and we use a calibration methodology, and we incorporate both public and private market multiples. For December and June valuations, we do kind of a more robust long form valuation. And then in September and March, we do a shorter form valuation, which really we take, unless there's been a material change at a portfolio company, you end up having the same valuation on securities as you did the prior quarter. So unless there's been a material change, we wouldn't move it. So obviously, as of March 31st, which was the short form valuation approach, there had been a significant impact given COVID. So we really looked at the scope and the complexity of the pandemic, which was evolving at the time. We wanted to continue to utilize the same valuation approach that we had, that we currently have. So we took that approach and we really looked at which portfolio companies as of Q1 had experienced a significant disruption in operations. And any company that was really determined to be significantly disrupted, we applied a 15% COVID-19 discount to the 12/31 to the year-end enterprise value. And then we really looked at the impact of that, running it through the current waterfall. And so that was really how we handled the valuations as of Q1. And we had the portfolio companies really where there was a significant impact. It was more on the kind of consumer retail end market exposure was really what was driving kind of significant disruptions at that time. So what we felt was the best approach here in terms of making sure we wanted to make sure that the LPs really understood the methodology that we were using. So in conjunction with our Q1 reporting package that we sent out to the LPs, we also included a memo about our valuation approach that provided them the details so that they, as they were reading the financial statements, could understand the methodology that we were using.
So then, Zach, I guess, just kind of pace it forward to Q2 and then Q3, you had that 15%, discount to the December valuations, as you kind of got into the next quarter. And now as you looked at the third quarter, based on what's kind of, facts and circumstances and kind of what's known and knowable today, is that, do those companies still, was that a reflective of an accurate estimate? And are those the businesses that still have, taken some hits and continue to do so?
Yeah, so I think that for us, the businesses that were most significantly impacted were the ones that had some challenges going into COVID. And with Q2, there was just, I think we had a little bit more visibility in terms of what the impact was on these portfolio companies. At that time, it was really kind of, late June into July as we're going through our valuation process. What we did was added a COVID-19 section into our valuations into the narrative to discuss the impact, the current status. Many of our portfolio company management teams initially were much more concerned with managing liquidity than they were, at that point, generating revised projections for 2020 and beyond. So at this point, by June, early July, many of our management teams had put together revised projections for 2020. Had seen kind of a bottom of many of our companies, and it's geographic specific and also industry specific. But many of our companies had seen kind of a bounce off the bottom when we were going through our June valuations, and actually some of them had seen some pent up demand that was starting to move through the company. So we were looking at current trajectory at those businesses. We were looking at permanent impairment versus temporary impairment, and really, I think that's an important factor to look at here. If you have a company that you think has been permanently impaired, I think that that's a little bit different approach than one that we feel has been temporarily impaired, and we've seen kind of that bounce back on.
Yeah, no, that's good. No, thanks for sharing that. That's it's clear you guys definitely had a methodical and very granular approach to how you handled it and assessed it. So let's just pivot a little bit to the space between February, March, and today. And what I'd like to do is, just for the sake of the audience, is kind of bring it forward and talk really from a private capital markets perspective. So, what have you been seeing in terms of deal flow? The quality of deals that you're seeing, and then ultimately, valuation of the deals that you're seeing. Can you just give us a little insight there and kind of what type of things you guys are seeing in the market today?
Yeah, sure. So I think kind of immediately when COVID hit in March into April, we saw a significant decline in deals here. I mean, we really shifted focus to portfolio management and providing whatever support we could to our portfolio companies, which included obviously helping them navigate the PPP loans. That was a big part of what we were trying to do from a support perspective. We saw an improvement after, I think it was probably mid-May when we really saw kind of a replenishment of our pipeline from a deal perspective. And we still are seeing a decent number of deals out there. I think one thing that we saw initially that's still true is we saw a number of banks kind of pulled back in terms of either really pulling back from the market or being less willing to go kind of 2 times through in terms of leverage or whatever the number was. They really kind of wanted to reduce their exposure. We also saw BDCs pulling back in late Q1, early Q2. I think they had challenges accessing capital given the contraction in the stock market and their share prices. But I think from a private markets perspective, you still have a number of private debt, private credit funds, private equity buyout funds that have a lot of dry powder that still need to deploy that capital, right? So I think what we've really seen is a significant number of deals that are out there and looking to get done, but there's a small subset of those deals that have been insulated, I would say, from COVID-19, and those deals are commanding a significant premium. There's been a lot of competition around those deals. We've been involved in looking at a few of those opportunities and with other sponsor groups and really thought we were putting in a pretty healthy valuation, and turns out we really got blown out of the water on a couple of those. But there's a lot of deals out there with some hair on them, and I think we were certainly taking a very cautious approach given the remaining uncertainty, the existing uncertainty here that's still in the market. So yeah, so I think there's definitely a number of opportunities out there. I think another thing just to point out here anecdotally that we've heard from a few business owners that we've spoken to, a number of these owners are concerned with a change in administration here after the election and what the impact might be on long-term capital gain tax rates and are really, that's also, I think, driving people to want to get something done this year. So from an opportunities perspective, I think that will also continue to drive opportunities for the remainder of 2020. Personally,
great. No, thank you. That was very helpful and informative. I always think it's good just to hear kind of what's going on in the marketplace and what you're seeing. So thank you. So we're going to pivot. We're going to move over and we're going to talk a little bit about kind of getting to fair value in today's environment, and some of the things that I'd like to talk about there and is really normalizing earnings, multiples, methods. And, I think, obviously so much has changed in the world today, but what hasn't changed is the approach to how we value an investment. So, the definition of fair value hasn't changed. The LP requirement of fair value reporting hasn't changed. The notion that fair value is not a fire sale price, and the fact that fair value contemplates, market participant conditions hasn't changed. So, I think we often think of the fair value assessment as primarily being quantitative in approach, and it is. There's a big component to it that's certainly quantitative, but I think a large assessment has to be done, especially in today's environment, around the qualitative aspects of the underlying business. If you think about, certain businesses that have thrived during these times and other ones have not. So, the macro environment and the portfolio company specific value drivers are so important in that qualitative assessment. So, I'd like Carmen, perhaps to talk a little bit about, those qualitative factors, the macro environment, and then the company specific value drivers that, as folks are getting ready to gear up and, prepare the year-end valuations, things that they should be considering and then ultimately documenting in their approach.
Sure, Chris. As you stated, fair value, the framework for estimating fair value, it has not changed. It's consistent, and it's based on an exit price at the time of the measurement date. And so it incorporates a market participant view, and it is not a fire sale. It's an orderly transaction. And so with respect to some of the qualitative information that should be considered in the analysis, you do want to take note of how the portfolio company is positioned to sort of address some of the challenges that have surfaced as a result of various regulations or restrictions that have been put in place by the various government agencies in order to slow the spread of COVID-19. You want to assess how some of the general economic indicators are going to affect the company's performance over time. As Zach stated earlier, you want to determine whether or not these are going to be temporary or permanent. How is management going to position itself on a go-forward basis, given some of the things that we've been seeing in the economic environment? For instance, you have GDP growth estimates that have significantly declined over the past 6 months or so. Those declines in GDP are expected to slow over time. You've also had an increase in government spending. Unemployment rates have increased. How are all of these things going to impact the portfolio company should be considered within the analysis, and that provides a little bit more transparency to the investors when you're documenting the considerations that you've made and what's gone into the analysis. And so I think Zach pointed out too that one of the very important things is, where is the portfolio company in its stage of development? How is it positioned in terms of leverage, liquidity? Does it need additional capital to hit certain milestones? How is that factored into the analysis of fair value? Another thing you want to consider is how disruptive some of these policies have been. How have supply chains been impacted? How have costs been impacted as a result of, differences in workforce and employees and health safety concerns? How has your product delivery method been altered as a result of that? Customer buying powers and spending patterns, that's all going to impact your portfolio company valuations. And so those are some of the items that you really need to take a deeper dive into and document and make sure that with these changes, there's going to be increased scrutiny over how you developed or some of the factors that were considered in determining what the fair value of these portfolio companies are. And so it's going to be important to document such. So that's one of the things that we, from at least from an audit perspective, would like to see is an increased level of transparency and documentation with respect to the impact of COVID-19 on these various value drivers. Now, when you get more into the company-specific factors, what drives value? Well, I can think of 3 primary things that drive value. One is revenue, the other thing is earnings, and the other thing is the growth potential for the portfolio company and how it's positioned currently as of the valuation date. An investor doesn't buy a portfolio company based on historical performance. They want to know what they can expect for return for their money in the current environment, and what are the expectations on a go-forward basis. With respect to some of the revenue drivers and things that impact that, does the company have diversification of customers, suppliers, products, services in this environment? Is that a good thing? We talked about different rules or regulations that have been implemented or restrictions in there. They're very much regionally based. And so those can differ across the board. Does diversification in this instance provide an advantage for the company, or is it a matter of tracking a lot of different regional restrictions and making sure that the company is compliant in those different regions? Does the company have changing delivery methods or systems that impact revenue? Are they close to their consumers? Is there a way to do more online direct end user contact? Those are things that need to be addressed. With respect to some of the cost implications, how's product sourcing? Is it delivery, transportation of both supplies or inputs to your cost of services? What's your exposure with respect to inventory? Is there a buildup in inventory? I know, Zach, you mentioned that some of your portfolio companies did see an increase in pent-up demand from delays in the first quarter, and then they're starting to, at least become more active in that respect in the latter part of the second quarter. How have you had to address different employees or employee factor? Do you have to rearrange your facilities? And how is management and their ability to change to different environmental circumstances, right? What is their level of expertise, and are they adaptable? These are some of the things that I would definitely take more of a deep dive into to determine how the company is positioned within its industry and within the economy to address some of these challenges that we're seeing as a result of COVID-19.
Great, thanks, Carmen. And Zach, I asked you to comment. I think, having looked at the Ironwood valuations for a number of years, I think, that's probably one of the, you guys do a great job. And I think the area that you folks spend a lot of time on is the narrative. It's kind of the market overview and kind of bridging, the portfolio company and, to the market, and maybe just talk a little bit about, how you guys do it and, assess the qualitative components as part of the valuation exercise over at Ironwood, because you guys do a really nice job.
Yeah, sure. So we use the valuation process as an opportunity to really do a deep dive with each portfolio company. I think when you look at the deal teams specifically, they can get into the weeds and know a lot about each portfolio company, but from kind of an overall management perspective here at Ironwood, the valuation process is really how we get to get that level of detail and understanding about what's happening real time at the portfolio company. So our process, we have 10+ page valuations that we do for June and December, and it includes an overview section. It's got the financial performance, it has the outlook, it's got an industry section, it has a risk rating section. We have a proprietary risk rating where we look at a lot of these different risks, many of which are the risks that we've been talking about here relating to COVID, just translate to overall risk at the portfolio companies, key value drivers, and then we go through in depth in terms of our valuation recommendation, really going through the process with our calibration approach, and really providing a lot of support. I think the detail and the support is very important for whatever approach that you're taking, because there's multiple components to each valuation. You have the key inputs, EBITDA and multiple, and just supporting the rationale for whatever you're using for those is really where we spend a lot of our time. So, we look at quantitative, we look at qualitative, and we really just try to make sure that whatever the approaches that we're taking for a specific portfolio company, there's a significant amount of support for that approach.
Great. No, thank you. So let's now pivot to the quantitative aspect. So, we've talked about, normalizing earnings, and, certainly a lot of challenges there, especially in, where we are today, and kind of looking out into the future. We've heard, is the business temporarily impaired? Is it permanently impaired? So I think a lot more needs to be considered, especially this year, during this year end, and as you're looking at projections. So Carmen, maybe just talk about, from the quantitative aspect, the things that, folks need to be thinking about, contemplating, whether it's, utilizing multiple scenarios, different methods perhaps to bring in based on, if the business is greatly impacted and, business and earnings are down, the need to perhaps utilize an income approach, and then, weighting of different scenarios. So maybe just kind of talk through kind of some of the things that, you'd expect to see on the quantitative side of the valuation exercise at year end.
Sure. With any valuation, the baseline is projected cash flow and what your expectations are going to be on a go-forward basis, right? And if you take EBITDA, for example, a lot of funds I see trying to normalize or provide a realistic, sustainable level of EBITDA on a go-forward basis, so that they have that transparency and they're able to provide that to their investors, and they've really kicked the tires with a variety of different levers, some of which we just talked about before. How is this impacted, whether or not it's going to be temporary, and how long is it going to last in the event it is temporary, right? Because, quite frankly, when we go back to the beginning of the year, I'm not sure if anyone expected, this to continue, and it's still continuing. There are still a number of different restrictions that are still in place. And so you do see that you have various scenarios that you might want to explore with respect to, if this happens, then this is going to be the impact, and you try to quantify that based on what you know and the visibility that you've had during the first quarter and second quarter of this year. That does provide you with a little bit of historical experience as to how the company might be adaptable to changes in the marketplace, to changes of delivery of services and products, et cetera. And so scenario testing is a good way to sort of capture the different impacts and the different timelines with respect to the earnings of the company. So that's one thing that I see is, as far as some of the different methods that are being used. I've seen a number of different proposed methods. Again, the valuation foundation and principles are the same. It's just that capturing the impact of COVID can be challenging because there is so much uncertainty as a result of quite frankly, a lot of the restrictions and policies put in place in order to slow the spread of the virus. And so you do have scenario testing. You can determine, depending on the state of development for your company, whether or not, a market approach would be appropriate or an income approach would be more appropriate. Say, for instance, if, it might have a longer term to recovery, you may want to consider the use of an income approach, and you can layer that growth into your forecast depending on how long you might think it takes to turn the tide, so to speak. If you are using a market approach, you want to make sure that you level set the information or the inputs that you're using in your analysis so that you're comparing apples to apples and the time periods are consistent between what you're seeing from a public company and a private company perspective. You can't just look at what's going on in a specific industry, I think it's much more important during this time to look at the specific company and how they've been able to respond to changes in the current environment, right? So you might take the restaurant industry, for example. You've got fine dining, you've got family dining, you've got fast food. Each one has a different set of opportunities or challenges as a result of some of these changes that have taken place, right? And how that's impacted and how the specific company is positioned is going to be helpful. And then, you know, once you've determined that, you've kicked the tires on some of management's projections as far as sustainable growth and sustainable cash flows, then one of the things that you want to do, for instance, if you're looking at a market-based approach, you want to be able to compare that to your peer group, compare the performance of the company or the expectations of the portfolio company with that of the peer group. Are they up? Are they down? I call it the over under, right? Are they going to outperform their peer group, or do you anticipate it having challenges with respect to the peer group because of a variety of things that the company might have specific to it? It could be geography based. You know, here in the United States, you have a number of different, a variety of different restrictions in place depending upon the locality. And so if your company is operating in a more restrictive or less restrictive area, it may have, you know, either benefits or sort of more challenges as it relates to that. And so the comparison of your specific company to those companies that have been selected as a peer group is going to be important. And you should select the multiples with that in mind and be able to document whether or not, you know, you have a plus or minus in relation to what you're seeing in the marketplace for multiples within that industry.
And then, thanks, Carmen.
Mm-hmm. Yep.
And then Zach, I guess, you know, any comments there? I think, you know, as you guys are, you know, gearing up for year end and, you know, looking at, you know, projections and forecasts that businesses are putting forth to you, you know, what type of, you know, how you're scrutinizing them, how you're looking at EBITDA, normalizing earnings, you know, because obviously I think, you know, that's probably one of the biggest challenges this year, you know, with the valuations is going to be that normalization of EBITDA. And there's been a lot of discussion about EBITDA C. You know, can you maybe just kind of give us your perspective and kind of what you and the team have talked about as you're getting ready for year end and how you're going to assess it?
Yeah, I think it's important to note that it's very portfolio company specific, right? Because each company, as Carmen alluded to, has kind of handled the COVID and the pandemic differently. Some have been really good at managing through it. Others might have had more challenges. So I think you really need to look at each portfolio company, look at those key risks and the key value drivers, and understand how they've been able to weather this storm relative to other companies within the same subsector. And so that's what we look at that. We look at, you know, I think as part of our normal valuation process, we incorporate it's really kind of a calibration premium or discount analysis. So we're looking at how our company, based on when we initially underwrote the deal and did the deal, was performing relative to the public markets. We're using Cap IQ and industry baskets, and so we're looking at revenue growth. We're looking at EBITDA margin. We're looking at leverage, and then we're comparing that and rolling it forward and saying, okay, well, the public markets since our initial investment, all of these statistics have contracted. In our portfolio company, all of our statistics, all those statistics have actually improved. So do we need to revisit what that initial calibration premium or discount was that was assigned to based on our initial entry? So looking at statistics like that, I think, are also important from a valuation perspective.
Great. No, thank you. And that's a good segue into the market multiple. And, I think there's a greater disconnect than ever before between the public and private markets. And I think it's safe to say the private markets are generally less volatile in terms of value when compared to the public market. So, as we think about the market multiple and, calibration and, some of the things that we have to consider there, I mean, there might be instances where, transaction price may not be the best, estimate of value. So Carmen, maybe just kind of talk about, we talked about the normalized earnings, that qualitative approach. Now let's talk a little bit about the, the market multiple and, what factors we need to be thinking about in coming up with, the appropriate, market multiple for the year-end marks.
Sure. As you stated, there is less volatility in the private market. We've seen that over time, and we've also seen a tighter range typically with respect to multiples paid for private companies in these private company transactions. The public market and the reaction to COVID, you have that, so to speak, immediate gratification. So if you have a little bit of or less appetite for volatility or uncertainty, it's easy enough to transact. We saw significant declines in the public markets over Q1, and since that time, they've been able to recover a lot of the losses that they sustained. And so, when you're looking at applying a market approach, there are a couple of things that you just want to keep in mind. You want to make sure that you again level set the multiples to account for timing, right? So, for instance, if you are capturing a multiple as of the valuation date, let's take Q2 for example, you're looking at multiples for public companies at 6/30/2020. Well, those multiples have already incorporated some type of risk associated with COVID-19, and they've applied those most likely to earnings that are prior to that period because of the lag in public reporting. And so you want to make sure that you're not double counting you're not penalizing your portfolio company or double counting either enhancements in the performance of the public portfolio company or challenges there. You want to make sure that the periods are consistent when you apply the multiples. So that's one thing that I really want to stress. The other thing that Zach discussed is the calibration. It can still be used. The multiple may be up or down depending on the quantification of the impact, the duration of impact, capital requirements, and access to capital, and what are the cost structures associated with that. And so I do think that is also a really good piece of evidence for the fair value of the portfolio company.
Great. Hey, Carmen, just one other thing I just wanted you maybe to talk about, just comment on,
Sure.
and I know, it has to do with the new lease standard. So many of our clients utilize Capital IQ, and kind of picking the marks and the comps. And, there's been a little bit of a pivot and a little bit of a change with, some of the new, accounting for leases and how it impacts multiples. So just to be mindful of this as we look to the, year-end calibration and comps, if you will.
Yeah, so that is one thing that you have to be aware of. Specifically, I know that the accounting requirements, accounting reporting standards regarding leases has impacted multiples, and so you want to make sure that you're adjusting for differences in the public market between public companies when you're looking to apply those multiples. For instance, now FASB is requiring that operating leases are included as debt in your capital structure. And so if you're pulling multiples from, say, Capital IQ, and you have companies within the industry that have various levels of operating leases, that's being picked up or might be captured as debt. And so when you're calculating your market value of invested capital, that's going to increase by the amount of operating leases that you may have on your balance sheet. And so I think what Capital IQ is doing now is they are including the operating leases as part of debt, but they are also including the operating expenses and its impact to EBITDA, so that there is more of an apples to apples comparison. I know that when we look at market multiples and adjust for operating leases, we take them out because different companies might have different levels of operating leases in their financial statements. And so in order to get a comparison, we adjust that out when calculating what the multiples are, and we also exclude that from EBITDA.
Okay.
So
Yeah, no, I just wanted to highlight that because it is different this
Yep.
year. It can have an impact, just to be mindful of that. All right, so we're going to pivot. I want to just talk a little bit about PPP loans, and Zach, I'm gonna ask you. As an SBIC, you folks were obviously fortunate to be exempt from the affiliation rules, and I know a lot of the portfolio was able to secure PPP loans. So maybe just talk a little bit about really two things. One is how you're treating those loans in the waterfall as you're going through year-end valuations. And then also maybe just address how the portfolio companies are documenting kind of the forgiveness aspect of the loan.
Yeah, sure. So in terms of your first question, with valuations here going into year end, we did have the majority of our portfolio across all of our funds was able to access the program, which was very beneficial for the companies, and a number of them have begun the forgiveness application process, and it's really being driven by the banks and whether or not they have the portal set up for the forgiveness application. But I think if the loans have not yet been forgiven, we are working with the management teams to understand what the expectation is in terms of forgiveness, and we are including them in the waterfall so that you can see what the PPP loan amount is. But we are netting that in the waterfall with whatever the percentage of forgiveness expected is. And so for most cases, most of our portfolio companies are expecting somewhere between 80 and 100% forgiveness. But that is the approach that we're using in our waterfalls for the PPP loans, and obviously supporting documentation narrative in the valuation to support whatever the approach is that we're taking. From a documentation aspect with the portfolio companies, I think what we did, so we either have board representation or board observation rights with all of our portfolio companies. So we were working with management teams and boards throughout kind of the initial pandemic, and when the program was being rolled out, we really pushed our portfolio companies to set up a separate bank account for traceability purposes. We thought that would be much easier. I think when you look at it, payroll is the majority of the forgiveness for the portfolio companies. We've seen a number of payroll providers that are providing support to the management teams for that aspect of the forgiveness. So that may be something that you want to talk to your portfolio companies about in terms of reaching out. If they're using ADP or Paychex or whatever their payroll provider is, they may have reports that they can provide to help support the forgiveness application. And I think, again, as I mentioned before, the ability for submitting the forgiveness applications here is kind of dependent on the individual bank. So we've seen a number of them that are still setting up their systems. Many banks are working with the management teams here to ensure that the portfolio companies are providing the appropriate documentation from a forgiveness aspect. So that's really, I think, from a documentation perspective, what we've been seeing.
Okay, great.
Chris,
So,
one thing I just wanted to mention with respect to the PPP loans and forgiveness. I do understand that, you know, provided the company has used those funds and can document the use of those funds for specific items, that those loans will be forgivable. But I did want to point out that, you know, the IRS has taken the position that to the extent that expenses that were otherwise deductible but have been basically covered by the PPP loans, that those expenses may not be deductible for income tax purposes. And so when you're looking at the add back from those PPP loans, just make sure to consider some of the tax consequences that could be associated with that loan forgiveness.
Yeah, that's a good point. That's a really good point. Yep. You know, we're kind of moving inside of coming up on 12 o'clock. I just, you know, Zach, and just one last question, I guess, you know, and then we'll open it up for questions and we can conclude. But, you know, the government put a tremendous amount of liquidity into the markets, and they did so very quickly. You know, can you just talk a little bit about how the Main Street lending program and the other government assistance programs, you know, have impacted your portfolio, you know, for better or for worse? Maybe just kind of give a sense as to, you know, all this liquidity in the market, you know, how has this impacted kind of the overall portfolio? And then also, I think the only other last thing I'd ask is, you know, has the outlook or the original exit strategy, the timing of, you know, final exits changed at all? I know there's a couple questions in there, but
Yeah, sure.
I'll pause.
Okay. All right. I will do my best here on those. I'll start with your question on exit timing and our approach here. I think again, it's portfolio company specific. I think, you know, looking across the portfolio really depends on how long these companies have been in our portfolio for. You know, if we were really kind of actively seeking some type of exit opportunity, in many cases, that's likely going to be pushed out a little bit from a timing perspective, although we have actually had, we've got a couple of exits already this year, and we have another one that is in process here. But I would say for the most part, timing would be pushed a little bit. So again, certainly portfolio company specific, and also dependent on temporary versus permanent impact from the pandemic. So all of those things are factors. I think when looking at the liquidity here in the market, you know, I think what we've been doing is there's a number of banks that have recently become active with the Main Street lending program, and I think it's more so some of the smaller regional banks that from what we've seen at least. And so we've been talking, you know, to management teams and looking at options because it could be very favorable from a cost of capital perspective and a fixed charge perspective, to see if you can get refinancing through this Main Street lending program. And, you know, it could be an opportunity, at least, you know, depending on kind of what leverage looks like and performance looks like. It depends on the underwriting at these banks, but could be a good opportunity to potentially get some or all of your sub debt back as well, if you're a credit fund and looking to kind of take some chips off the table and de-risk. So that's what we've seen that as a potential opportunity here for exits, more so on the debt side with a refinancing than on a full exit sale of the company. But that's I think that answers your questions, correct?
Yeah, no, it does. Thank you.
Sure.
So, you know, I'll just ask maybe Carmen, just closing thoughts, you know, best practices, you know, key takeaways. I thought the dialogue, the items that we covered were very relevant and important, you know, as folks get ready to, you know, gear up for year-end valuations and audit season. Carmen, maybe just, a couple minutes on final key takeaways from today's conversation.
Well, some of the key takeaways are you have to look at this as a portfolio company specific endeavor, right? And I think one of the unsung, or one of the qualitative aspects is the management of the company, right? And how adaptable they might be to change, how flexible they can be in challenging environments, and their ability to change operations or be flexible in the way in which they deliver their products or services. I think that's very important as far as an assessment of risk. The other thing I wanted to point out, and I'm glad that Zach mentioned this with respect to some of the rights of their specific interests, that allows them board representation and more visibility into the portfolio companies. I mean, if we remember, we talked about portfolio company valuations, and that's a starting point, but we do need to be mindful that the fair value is of the specific interest held within the company, right? And so we've mentioned before that the framework for fair value has not changed. And I know that the AICPA recently published guidance with respect to varying investment vehicles that might be held within the portfolio company. And so I would revisit those and just make sure that you're consistently applying the appropriate methods to value the portfolio company, and then allocate that on to your specific investment held when reporting your investment. Great.
Well, I just want to thank Carmen and Zach. You guys did a great job. I really enjoyed doing the panel with you this afternoon, and we, enjoy working together and look forward to, this coming tax season, going through all our valuations together. But thank you for participating, and then, again, thank you to the SBIA for hosting and putting this together. We're proud to be, affiliated and sponsors of the organization. So, with that, I'll pause and turn it back to Ainsley over at SBIA.
Great. Thank you, Chris, Carmen, and Zach. That was a very timely discussion, and we appreciate the expertise that you have so graciously shared with our membership. A replay of today's webinar, along with the presentation materials, will be distributed to SBIA members and will also be available on our website at sbia.org, where you can also view previous webinars and materials. Our next Lunch and Learn webinar is Tuesday, September 29th, and will feature a discussion about corporate performance management, a key element to mid-market transformation. In addition to the SBIA webinar series, we hope that you will participate in one of our upcoming fall events. This year, Capital Links is going virtual and is scheduled to take place the week of October 26th. Registration deadline, however, is October 2nd. Virtual Capital Links, as many of you know, uses a strategic matchmaking platform between institutional investors and lower middle market funds, offering an exceptional networking opportunity for GPs actively fundraising or going to market soon, and for LPs looking for new fund managers to invest in. SBIA is also hosting golf networking events around the country. These small group outings are open to non-members and are a great way to connect in person in a safe, friendly setting. Please visit our website at sbia.org for details. And if you're not an SBIA member and would like to learn more about joining our organization, please contact my colleague Alex Frick by email at membership@sbia.org. Finally, thank you for participating in our webinar today, and we look forward to having you join us again next week.